Afternoon, ladies and gentlemen, and thank you for standing by. Welcome all to SIN's audio conference to discuss results relative to Q2 2021. And this being the first earnings announcement for the company under its new corporate name. The audio and respective slides are being broadcast over the internet at the company's RI site, ri.sin.com.br. We would like to inform you that all participants will be connected in listen-only mode during the company's remarks. After that, we'll start a Q&A session when further instructions will be provided. Should you need assistance during the call, please request the help of an operator by pressing *0. Before moving on, we'd like to say that forward-looking statements contained in this conference concern future events and are submitted to risks and uncertainties, which may lead such forward-looking statements not to materialize or be considerably different from those expected. Those forward-looking statements refer to the opinion made on the date they're made, and they're not obliged to update them in light of new information. Here with us today, we have Mr. Thiago Muramatsu, CEO, CFO, and IRO, and Mr. Hector Leitao, Financial Superintendent. Please, Mr. Muramatsu, you may carry on. Good afternoon, everyone, and thank you very much for making time for us today. I know you're all very busy, but thank you. This is the first earnings call for SIN, our new corporate name, and we have adopted a slightly different model of making the announcement. We're using the video this time. So kicking off, going straight to slide number 5, we were talking about our new brand. We've been talking about it with investors. Our IR team has been in close contact with the market to talk about this new brand, and more than just the name, our signature, prop and tech. What does that entail after all? All that emerged from a desire that we had from the management, from shareholders, to be able to position the company, a company which already is a benchmark in real estate, commercial real estate, especially here in Sao Paulo, the main buildings in Faria Lima. We have the most complete portfolio on Faria Lima. Take all that and link it with technology, because that's something we see as very promising in terms of growth. And what sets us apart, unlike other tech companies, we do have real assets. So the name SIN comes from synergy. So the idea is to create that synergy across people, business, and technology. Much more than simply take our business to the digital realm, but to invest in new business models and related parties for the real estate market. Now, moving on to the next slide, slide number 6, a bit about happening the second quarter. Number 1, we have our 13th debentures issuance to the tune of 300 million in 2 series. The first one maturing in 3 years with a CDI plus 170 as a fee, 175 rather, and the second series of 200 million, 4th and 5th year amortization, CDI plus 2.04. It was concluded in April 2021. This is something we've been doing for some time now in trying to maintain the level, not only the leverage level of the company, but also the amortization ladder, all of that in line with our revenue streams. So the amortization line would be as flat as possible. And we've been doing that, extending that and making new issuances with that objective in mind. Also important accomplishment in the quarter, it'll appear on our next slide, our leasing operations, especially leasing the AAA properties. We closed the quarter with 100% of leased on Faria Lima and JK 455. a little over 3,000 square meters in the quarter, and JK, 1,000 square meters. Moving on to slide number 7 now, to continue in terms of new operations. The Faria Lima Financial Center, we had some leases, so the net result was an increase of over 4,000 square meters of leased area, and at the JK Tower, another 1,000 square meters. Right now, they are 100% leased at this quarter. So have a very positive outlook for the AAA portfolio on Faria Lima. For AAA in São Paulo, we are almost to full capacity, full occupancy, and we have some more things to come our way in 2022. So we do believe that this was a very timely moment to do that. Another important subsequent event, and is quite relevant and has to do with our new brand and with the new positioning we're trying to take on moving forward. The appointment of 3 new independent members to the board from the previous board. I'd like now to take the opportunity to thank our board members who have resigned to make room for this new board members. They spent many years at the company, so a big thank you for your support throughout those years. And they were kind enough to provide space for 3 new members. So in addition to Eli and Leal, they remain on the board. Claudia also remains in the board, an independent board member who is very, very experienced in real estate. So we have the founder, the CEO of BR Properties. They've been around since the foundation until 2016. He also to be the chairman of the board of BR Malls. José Carlos Magalhães, a very experienced individual, very knowledgeable in terms of capital allocation. Flavio Pripas, one of the founders and the head of Cubo, Itaú Bank's startup innovation center for some time, and now he is one of the partners at Redpoint, a venture capital firm, very much involved with startups and tech companies who are emerging. And lastly, Christian Ruber, one of the co-founders and CEO for New Businesses executive, and he used to be the CFO for Loft, a native prop tech company, one of the most valuable in Brazil. So we are sure that this new team gathered at the board will contribute to our business in a very significant manner. And of course, we also have very important names to provide us support in terms of guidance towards the tech journey. A little bit about the COVID impact on the next slide, slide number 9. The second wave impact caused a big impact on the business. There are 2 main facts that stand out and that helped us contribute to this recovery. The first one is the fact that our portfolio is very much concentrated in São Paulo. We have 4 shopping malls in São Paulo, in the metropolitan area of the city. Out of the 6 that we manage, 4 are in São Paulo. And those 4 have a very good share in terms of sales and leasing when you compare that to malls outside of São Paulo. And secondly, and that was eventually a factor that sort of hindered the recovery, it was the Cidade de São Paulo shopping mall. Until February 2020, ranked as one of the 3 largest lease values in Latin America. It still has a very high level of lease and value, but the recovery was hindered because it relies on the office population that works on Paulista Avenue, and they're just now going back to in-person work, and also relies on tourism on the weekends, which is also only now beginning to resume on the weekends. So now, as the vaccination rollout advances, we do believe this will be mitigated, and we see a very positive results in same-store sales for São Paulo as a whole. When we look at the results from late June and early July, we see promising results in terms of recovery for sales. And now moving on to slide number 11, we decided to include a couple of observations about ESG, a recurring topic in our discussions with investors as a whole. And then we do not advertise what we do most of the time in terms of ESG, but we are already working on our sustainability report. Then this is a brief summary of some of the initiatives we have around ESG, environment, social, and governance. On the environmental front, we have the LEED certification in most buildings that we manage. Some of the buildings which are not here on Faria Lima are to be included. We have a chart to show the representativeness of the properties where we have so close to 90% of the cash that we generate in terms of office lease come from properties that have LEED certification, and also malls that have LEED certification. We also adopt the use of energy from the free market, both for malls and properties. We use incentivized energy. We do have waste management, sewage treatment in most of our properties and malls. We do have malls in our portfolio that are autonomous for water use. So that's something we've been doing since 2003, when we started developing the first buildings here on Faria Lima. As for the social front, we have the SIN Institute, the CCP Institute, as it used to be called. Now it is the SIN Institute, a heritage from Mr. Eli. We also have the Cirela Institute. They have as a pillar the social part. A part of the company's profit is allocated to the institute. Today, they work around four main pillars: employability, entrepreneurship, volunteering, and relationship. And all those four pillars are put around developments that we have in shopping malls mainly. So we have, that's part of what we said in our release. We have initiatives around training for a first job attempt. I personally take part in some mentorship programs for first job for young professionals, volunteer programs. Within the Tietê Mall, we have a collaborative store for people who live in the community. We do have a booth to service refugees here in the city of São Paulo. So we try to be very active, both in terms of employability and in terms of entrepreneurship and the environment in the surrounding areas of our malls. And so that sort of permeates across all pillars. That's something we do with a lot of passion and been doing for a long time. In terms of diversity, internally we do have a diversity committee. We have been fostering diversity actions, and we want to encourage the participation of everyone. Everyone is welcome. So we do have diversity across the company, and we have people from all walks of life getting engaged in the committee's activities. This has been going on for a year and a half now. Recently, we have a partnership with Zumbi do Palmares College with their president. It's a university for the Afro-Brazilian community. He had an activity going on during Black Awareness Day last year, and we do have dedicated outlets and some malls dedicated to the Afro culture. And on the COVID front, we made ourselves available to local governments to provide areas for vaccination. So some of our malls have been used as vaccination hubs. We have already seen 100,000 people being vaccinated in our malls. We do have a health committee too, and we have several other projects in place which are part of the SIN Institute to try and help mitigate the impact of the COVID crisis. In terms of governance, we are a company that is listed in the Novo Mercado since the spin-off of Cyrela. Most of our policies are announced publicly to all investors. We are very, very strict in that respect. We've had for at least 7 years a hotline for reports or in terms of data protection. We were one of the first companies to embrace that new law for data protection. And this restructuring of the board, we now have 2/3 of the board are composed of independent members. So that's also part of the governance efforts on our part. Now, moving on to the operating performance for the quarter on slide number 15. We have an occupancy snapshot. We have improved occupancy in terms of financial occupancy in the second quarter. It improved from the first quarter slightly, but it did. And this imbalance that we saw had to do with the reduction of idle spaces in AAA properties to the detriment of an increase in vacancy in Class A properties. And that, of course, reflects into the physical occupation as well. Now, specifically about shopping malls on slide 16, we saw a very significant growth in same-store sales in the Q2 when compared to the same period of last year. But a more fair comparison would be to compare those numbers with 2019. And then we had a drop, as you can see, of 20%. And I talked about the fact that sales were impacted in our portfolio because of the reasons I've mentioned. But the good news is that when we look at the results, and it's an uptrending number for June, we already see that same-store sales dropped from -30, and today we are at a level of 10 something, -18% of drop in same-store sales when compared with June 2019. And that's good news, provided we still have some restrictions. And now we hope to see a strong recovery going forward. And in terms of commercialization, we see that we see retailers seeking to expand. We see that happening in our malls. So for the coming quarters, we will have positive news to share in terms of malls. Now, a bit about our financial performance. I'll give it over to Hector to continue. Hector, over to you. Thank you, Tiago. Thank you. Thanks, everyone, for being here in our earnings call today. I think results acknowledge what Tiago has mentioned about the operational performance. When we compare leasing revenue and compare quarters on quarters last year, this year we see a growth of 21.5%, quite concentrated on shopping malls. The office is quite flat, quite resilient in the second quarter, and the shopping mall saw a great gain as restrictions were lifted, lockdowns were lifted, and that, of course, brings about revenue concerning parking lots, which also saw a significant drop in the first quarter, which impacted net revenues in a positive way too. Also, there is an inertia around discounts, and then we've been accumulating a large balance of discounts from March last year, and that sort of mitigates the growth that we would see in net revenues combined with the gross revenue. And so better parking lot revenue and better service revenue. So we grow net revenues by 21%. Moving on to slide 19 and talking about the NOI, it is also in line with gross net and gross revenue with a growth of 13.6%, very much impacted by the shopping mall's performance or good performance, but we see a drop in margin of 5%, quite concentrated on an increase in the cost of vacancies for Class A properties. So we have increased revenues for malls in a relevant manner. We have increased in the second quarter the office revenue streams, but we do have a vacancy cost which is concentrated, and we've been talking about it for the past quarters, and we have a small portion of retail which is leased now. So the NOI grew by something close to 14% in the quarter because of that. Now, moving on to adjusted Ebbta, on top of the NOI, we'll add operating expenses, SG&A and others. We have a growth which is even more robust, boosted by the SG&A efficiency and also by the services revenue stream, which is outside of the NOI. So we have a very significant growth of 41%, reaching the level of 74 million in the quarter. And then moving on to slide number 20, net profit follows along EBITDA, adding financial expenses, their financial results rather, and then we have a result of 150%, also quite significant. The difference there drops, the absolute difference both for the net income and the adjusted FFO because of financial expenses. We've been following an increase in CDI, which has a direct impact on our debt. And I'll talk about it in a moment about the increase in the cost of our debt because of IPCA variations, inflation variations. So we do have a growth of 25.7% in FFO, close to 40 million at the end of the quarter. When we look at the pro forma numbers, you see a drop of 8% coming from two main drivers. Number one being we saw a drop in NOI for shopping malls, which was quite concentrated in São Paulo, where we have a relevant share of the market. But at the same time, we've seen quick, fast recoveries starting in this quarter, and also because of debt. We have about 80% of our debt is corporate debt, so there is a higher impact on pro forma than on IFRS. That's why you have this 8% drop. Now, moving on to the next slide, slide 21, and talking about our debt. As Thiago mentioned, we issued our 13th series of debentures. So he asked for cash. We add basically 300 million, which were raised with the debentures, and there was no cash burn event in the quarter. So we maintained net debt at a stable level with a slightly higher EBITDA. So we see a marginal improvement also along that indicator, net debt EBITDA for the last 12 months, closing the quarter at 0.4 times, which is quite comfortable vis-a-vis our main covenant, which is 7 times. The limit would be 7 times. So we are quite comfortable at 4.46 times. And then looking at the history line of our financial expenses, we see that the company managed to explore an important drop of CDI from 2019, when they were close to 6.5 or 7 of Selic rate, and then close to 2% in the second quarter of last year, in the middle of the chart. Then, as we all know, I scale up and inflation this year. The IPCA went above 8% in the first half of the year, the last 12 months, July. So that also led to an increase in the Selic rate. And so those are the two main impacts on our debt: an increase in the Selic rate, CDI plus, and also 20% of a debt which is IPCA pegged, suffering an important monetary pressure on that side. So a good portion of the gains we've had until the Ebbta, we had this headwind in terms of financial expenses, if I may. And then moving on to the next slide, still about indebtedness, we see the amortization schedule for our debt. A debt profile that we have is quite flat, quite well spread out throughout the years, in line with our cash flow, in line with our operational cash flow. So in terms of our 13th debenture issuance, it was something we did to reinforce our cash with an eye at a more volatility scenario next year when we'll have presidential elections. So this way, we'll be quite comfortable until the end of last year. This will prevent us from going to market for more cash, especially in a moment where there's so much uncertainty. In terms of indexation, I've said that our debt is quite concentrated on CDI, about 80% of it, and then have a cost of corporate debt. That's where we are more concentrated, a cost close to 6.5 and an average close to 7. So that's the takeaway, is that we are quite comfortable in what concerns liquidity, and also in terms of needing to raise more funds next year. So this is it from my end, and I turn it over to the operator for the Q&A session. We'll now start the Q&A session for investors and analysts. If you have a question, please press *1. To remove your question from the queue, please press *2. You can also post your questions through the webcast platform at the chat box. Our first question comes from Mr. André Dias from Itaú BBA. Mr. Dias, please go on. Good afternoon, everyone. I have two questions. Number one, about leasing. You made an important announcement about AAA leasings. Could you comment on what's helping that movement? And also, if you are getting better prices for your leasing. I remember that in April, if you could talk about this process that started in April. Okay, Andrea, the sound was terrible. It was very, very difficult to understand your question. I'll try to guess what you said, because it was an impossible, terribly bad connection that you had. So anyway, so the main leasers here are companies linked to the financial segment. So financial institutions and asset management funds are our main clients in terms of leasing. So in terms of leasing conditions and level of leasing conditions, we have had no type of concession, if you will, nothing much different from what we did before. So today we're talking about a grace period of 4 to 6 months. In terms of amounts, it was sort of flat. We're talking about levels which are quite close to what we had in 2020, late 19. So prices came to a standstill. even though there was an increase in inflation, IPCA, we're talking about amounts which sit close to what we have in the end of 2019. As to your second question, Daniel, please correct me because I couldn't really understand what you said. But about the XP, one of the conditions was concerning the raising of resources. We delayed the closure of that negotiation because of the tax reform. So that brought about some instability as a whole. So the economy as a whole was affected, especially real estate companies were affected by the new tax reform. So until we really understood what was happening, what impact we would be suffering from that, so we sort of left that in the back burner. So that lasted for about 3-4 weeks, but we are now back in the game, and the XP fund is already out on the road shows. We should finish our funding early September for we to finalize the transaction. I've been talking with people from XP, and they see very, very little risk in terms of execution. So that's a transaction we should be announcing in the coming 20 days, I'd say. Okay. Our next question was sent via webcast by Mr. Tiago from Butiá Investimentos. Good afternoon. What is the reason for the vacancy rate to be so high in Class A properties? Brasilia Machado, Suarez Street, and Bremen Das are 10. Why the high vacancy rate? So thank you, Tiago, for your question. I think they have high percentage rates, but what's really meaningful there, both in terms of revenue and located area, are Bremen Das and ATM. So the first property, Suarez 3, it's located in Salvador, in Bahia, undoubtedly the best property in Salvador, but it is located in a much more challenging market. Not very many businesses are closed in the city. As a coincidence, this week we are signing a leasing contract there this week, coincidentally, but that's a slow negotiation. And we do have a price of around 40 reais. So based on the size of the area and the price of leasing, that does not mean a big impact on our numbers. As for the Brasilia Machado property that you mentioned also, it is a property which is well located, but it's slightly older than the average. We share control over that property. So we'd like to conduct some retrofitting works, but it's not that easy. It's going through a legalization process. But we're quite confident, in summary, that it is well located. And as the economy picks up, it has a very strong appeal. As for the Bremen 10, just to put it into perspective, we acquired that in July 2019. The property was totally vacant. We conducted a small retrofit, and then we leased it in 2019, leased 50% for KPMG. At the time, we had negotiations which were ongoing with 2 other potential leasers to finalize the whole leasing of the whole building. But that's exactly when the pandemic hit. So those 2 other prospects delayed their decision-making process. But as we see a recovery of the economy here in this region, for Lima, so we see some opportunities for flat price. So we have resumed some negotiations we had stopped at the Bremen Das. So we have a good outlook for that in the second half of the year, third quarter. Now, as for the ETM, which is the main offender of our vacancy rate or a high vacancy rate, we're talking about our own area of 17,000 square meters, which was occupied by Itaú. Its vacancy came about because Itaú changed their policy. Now they have this hybrid model of work, so they have shrunk their working areas, not only for us, but for other properties as well. And that's a property they had already scheduled to reduce occupancy before the COVID, actually. So half of the whole area was scheduled to be returned. So the pandemic hit, and so they went forward and returned everything, the whole building. We do not manage the development, and we do not develop the commercial negotiations. We provide support to the landlords, proprietors, owners, as best as we can. There are some negotiations which are ongoing, but nothing really concrete or material to share at this point. Our next question comes from Mr. Marcel Sampaio Tubini. Good afternoon. What is your expectation for leasing Class A properties? Thank you. Well, I did mention a bit of it when I answered a previous question, but Suarez trading is slightly more difficult, but we are doing some businesses, nothing major. Brazilian Machado, once we adjust documentation and some regularization procedures, and once the market picks up a bit, we have good forecast for that. As for Birman Das, we are resuming negotiations we had started before the pandemic. So I do believe we'll have good news going forward for Birmingham Das. And for ETM, we're not doing the trading itself, the sales ourselves, but we have been talking to the administrators of the building, and we have good signs that it will get better. Our next question comes from Mr. Arnaldo Luiz from Silari about the recycling of offices, or AAA offices, when compared to Class A. Are you taking that into account? Do you have an intention to increase exposure in that segment, and why? AAA as opposed to A. Thank you for the question, Arnaldo. We've been talking about the importance of recycling assets to increase profitability for the company's shareholders. So today, if I were to tell you where the focus is, it would be on our A portfolio. We've been talking about some of the difficulties we've had in terms of leasing the A portfolio, but we are not discarding a recycling of AAA assets as well, and also acquisitions. So we can do everything. We are trying to act on a timely manner, very opportunistically. So the sale of some malls were strategic, as we told XP, but we also have been assessing some acquisitions which are more opportunistic, especially because the market now is not very stable. So there is no price stable level, which is quite clear, especially for sellers. We know what we could pay, but there are not as many opportunities in the acquisition market, okay? Our next question from Mr. Vitor Hugo. What do you expect for the ETM asset? Would it be a last mile logistics asset for you? We have conducted some studies to transform it into a logistics center, last mile center, but partially. That's my answer. There are some other technical challenges to be faced, which make it difficult for us to transform the whole asset, at least based on the first assessments we've made. A full last mile transformation would be difficult. So we're thinking about a more hybrid transformation, but that's an ongoing discussion. But at the same time, we have a high demand for offices. So that's what we have been concentrating on, how we could migrate, be even partially for the ETM, but no decision has been made yet about that. Please stand by as we poll for questions. Our next question comes from Vitor Borosini. Can you comment on the share buyback program? What has been done and what are your plans going forward? What seems to be the best investment right now? Well, Vitor, that was our main dilemma. We executed two buyback programs last year. And when you compare the implicit price of the assets with the share price, that's the best investment we could make. But we will come across a problem we had last year, which is liquidity. Our share is not very liquid. We have a flow change of about 40%, a volume of trading of 3 to 4 million a day. And whenever we have a buyback program, we affect that movement. And we want to be a company that has liquidity, right? To try and remove that mismatch between the real price of our assets and the price of shares. One of the things we did last year after the two buyback programs was a dividend payout. The buyback is also a way for you to increase the share of shareholders in the company. And dividend payout is when you distribute shares to shareholders. So that's the way we found to improve the profitability of our shares. But now, going forward, we have been assessing other alternatives. I'd say buyback is not the most obvious thing to do because of liquidity issues, because the liquidity levels now sits at around 40%, and we do not want to see it go deeper than that, 40%. Next question comes from Mr. Fernando Teles. Good afternoon, everyone. About the XP deal, what are the plans to use the capital coming from the sales of shares in malls? New acquisitions, debt amortizations, new developments, all of the above? Oh, thank you for the question. It's a transaction of 265 million. It's not a cash deal. A first installment of 175 will be paid at the signing, and then the remaining will be paid in 4 installments. So for those first 175, we intend to reinforce our cash. That amortization might not be the best use for those resources because of the cost and the term that we have for our debt. When we look for the duration vis-a-vis cost, to amortize now doesn't seem to be that favorable. And given that we have this new strategy in place around technology, we might use part of those resources in technology. But as you said, it's a bit of all of the above. It's now in the company's cash flow, and that will help us in our amortization program throughout the coming 2 or 3 years. Mr. Fernando Tenis sent another question. If you could comment on the joint venture with SPX, is the intention to get revenue from administration fees, consultancy fees, or to become a partner and potential fee creation programs? Well, actually, it's a bit of both. Today, you have an AGV when you have 50% of the managers, and XPX also holds 50%. And there is a commitment of us to put in seed money in 300 million, 150 million each, actually, in the funds that are raised by SPX in those first 2 years. So we already have a fund being developed. SPX is now doing their roadshows, trying to explain the program. So I'd rather let them explain that to the market. So as for this first fund, we're already gathering investments, but the idea is for us to work toward a dilution of capital exposure, something close to 10% of the size of the fund, and then manage assets, and then manage the fund itself. And then, in addition, fees on top of the results of the investments themselves. Next question from Mr. Felipe. And something that calls me attention is the difference between the price filed for transactions and the secondary market for properties, AAA markets in the more noble regions of São Paulo, and the market prices. What are the strategies that the company has to be able to reduce that gap in pricing? Thank you for the question. It's difficult. One of the things we've been doing, and I did mention that before, one of the main problems is around liquidity. The liquidity does not reflect the value of our assets, but we've been trying to show investors, and during our earnings announcements, analysts who cover SIN will also tell you that there is a very big gap between the company's NAV when compared to market prices. So we need to try and show the real value of our assets and show the potential that we have in terms of growth and cash generation, and also this robustness of the company, our capital structure. All of that is quite favorable, especially in the moment that we live right now. And that's basically it. Not much more I can tell you. We have the divested in order to show the real value of our assets. Secondary transactions, a transaction that just happened, the sale of the complex B, JK, to the tune of 30,000 reais per the square meter, and Faria Lima, the value is superior. When you compare that to our square meter prices, our malls are close to zero when you make the comparison. That's a steep road for us to conduct a very analytical, qualitative analysis of the adequate price for us. We are quite discounted, to say the least. Ladies and gentlemen, please wait as we poll for questions. This concludes our Q&A session, and I'd like to turn the floor back over to Mr. Marumatsu for his final remarks. Well, this was very, very, very nice. A lot of interaction from you. Thank you. My final message is very optimistic. I think from the second quarter until now, that's about 40 days. In those past 40 days, we've felt quite a meaningful change, both in corporate and in shopping malls. New leasings happening across both fronts and the market in our portfolio. Our portfolio is close to 100%, as I said. When we talk about shopping malls, a very interesting growing flow in sales when compared to previous months. And I think the main driver for all of that is the vaccination rollout. So we do believe that in Sao Paulo this coming weekend, all adults above 18 will be able to be vaccinated. So this massive vaccination effort will reassure people. They'll be more reassured in going to shopping malls, going out on the street, going back to their offices. And that's what we've been watching as of recent. And this will help us in our portfolios, of course. So the outlook for our business is positive. I hope that this second quarter represented the last scare the pandemic gave us, and that from now on, things start getting back to normal, both on a personal level and also on a professional level. We're quite optimistic with what lies ahead. Thank you, and have a nice day, everyone. Since teleconference is now over, thank you all for participating, and have a nice day, everyone.